Many people do a lot of transactions. So look at yourself transferring shares, for example. Transferring land, for example. You're looking at 1.5% before and 3% moving forward. If that proposal passes, it would create good revenue, but I think it would stop many people from transferring particular assets that they have. So I think that this particular proposal should not see the light of day.
What that helps is that once this bill is passed into law, it means 335,000 of your income is not going to be subject to tax. Not a very significant amount, but depending on the different tax brackets, you'll find that there is a saving on a monthly basis.
So you're taxing a guy who is making losses 0.5% on his turnover. That is absolutely inconsistent with income tax principles.
As you know, Uganda imports a lot of foreign capital. We're a net importer of debt. So that, in essence, most agreements that you do, debt agreements, usually push that liability on the borrower. So the cost of debt will increase by 5%.
What that means is that once you're not registered for VAT, then the whole neutrality in terms of you claiming the VAT goes away. So now you have people who will be falling below a bracket of 250 million, all of a sudden becoming final consumers. So then they will have to pay VAT because they can no longer claim the credit.
The most important amendment in there, which to me is a big welcome because it's been a pain for many, is the waiver, which has now been extended to principal tax. I don't know if people understand that, but it is something that is going to lift so much off people's backs, and I hope it goes through.
I always argue that tax can go up to a certain level, but if it stops going up, it must go out. So you increase the tax base rather than increasing the tax rates.
We have had 3 years and no one has answered that question. But before we even answer that question, we are now having an alternative minimum tax to then tax you more, even when we don't know when the 7 years kick in.
From Uganda's perspective, I don't know if this pandemic is across Africa, but it has become a revenue generating, which should never be the case as far as excise duty is concerned.
What are some of the proposals that we have discussed in here or that you have come across that you feel need some more refining, need some more amendment, or you feel they shouldn't even be in the tax amendment bills at all? Good evening, ladies and gentlemen. Welcome back to the Tax Hub podcast, an educative and informative platform that focuses on taxation and the broader tax practice in Uganda. The Tax Hub podcast prides itself in having these discussions on emerging taxation issues in Uganda with tax practitioners ranging from government officials to private sector tax consultants, civil society organizations, and even representative bodies of the taxpayers. This is episode 14, and we are coming to you live from the Fontis Residence Hotel. It's tax amendment season, and we bring to you another important topic on the recently presented tax amendment bills. As you are aware, at the beginning of every financial year, the Ministry of Finance commences the tax amendment cycle by making a call for proposals to the general public. These proposals are considered and consolidated into the tax amendment bills. On the 1st of April 2026, we saw the Ministry of Finance present to Parliament a total of 8 tax amendment bills. These bills were received and forwarded to the Parliamentary Committee on Finance for consideration. Ladies and gentlemen, my name is Noah Opindeni, a senior legal associate at BDO East Africa, and I am privileged to moderate this discussion today. We are equally honored to be joined by a panel of distinguished tax practitioners of many years standing, who are going to break down for us the tax amendment bills and simplify it for what it means to the taxpayer out there. Gentlemen, welcome. To my immediate right, Trevor, you're most welcome to the podcast.
Thank you, Noah, and good evening to everyone, our viewers, and officially to the panel as well.
Yes, for the viewers out there who may want to know a thing or two about Trevor, kindly tell them about yourself.
Well, Trevor Lukanga Wanika is my name. So I work with PricewaterhouseCoopers in the tax line of service, and I look after international taxes as well as transfer pricing.
Thank you for joining us on the podcast today, Trevor.
Thank you, Noah. Glad to be here.
Next to him is Alfred. Alfred, you're welcome to the Tax Hub podcast.
Thank you, Noah.
Kindly tell us about yourself.
Thank you once again, Noah, and good evening to everyone who is watching or listening into this podcast. I'm Alfred Habasa. I have over 10 years experience in taxation. I've worked with the Revenue Authority. I had a long stint, 6 years, I don't know if that is wrong, in the petroleum and mining sector.
Yes.
Around this time, not long time, not far from now, I was so much involved in such processes. Not even around this time, but throughout the year, especially with the policy teams at URA and the policy teams at Ministry of Finance.
Yeah.
My work with the authority is sandwiched in between tax advisory work as from the consulting world.
Yeah.
I was with Ernst & Young before that. And now I'm I'm the team lead at Redmond Tax and Advisory, which is an associated firm with Redmond Associated Advocates. I'm also a certified public accountant of Uganda, but I'm also a lawyer, so I'm a dual qualified professional. I always say tax is where the law meets the ledger. And incidentally, it's just convenient for this discussion because we have had a lot of cases from anyone in tax knows the ledger issues we've had. It's just a simple matter of the ledger team. They don't want to know perhaps what the law is saying, or we could say the law is not, or the lawmakers are not seeing what the ledger teams are facing. But I want to thank the Tax Hub for demystifying these things. I encourage whoever is watching to look out for all the podcasts. It's not easy to bring this whole team, these experts, for free for whoever is watching the podcasts. And I hope my experience can bring some perspective to this discussion and see how these amendments can impact the economy for the Uganda we love. Thank you.
Thank you, Alfred. We are privileged to have you here. And lastly, Ian, welcome to the Tax Hub podcast. And kindly tell the viewers something about yourself.
Thank you, Noah, Trevor, and Alfred. First of all, I'm privileged to be a part of the podcast today. I thank you to the Tax Hub for having invited me for this particular episode. My name is Ian Mutiwa. I'm a tax partner at SM & Co. Advocates. I also head the entertainment space. Whenever I say that, people laugh, but it's an interesting space to play in. But for this particular episode, I'm here as a tax practitioner and trying to demystify what the bills are bringing, or what the law that you expect to pass 1st July 2026 is going to bring for this nation. Thank you.
Gentlemen, we are honored to have you here. Viewers, I think you've heard it from them, the wealth of experience and expertise they possess in this area of taxation. So I want us to dive straight into this discussion, and we'll start with the Income Tax Amendment Bill. We have seen it has a set of comprehensive proposals, the most among the other amendment bills. And these proposals have far and wide-reaching implications for the taxpayer and the economy in general. So, Trevor, from your analysis of the income tax amendment bill, what are some of those proposals that stand out to you, and why do they?
Thank you, Noah. So I'll speak to those that stand out, like you've said, and those that may not be as controversial, because I would like to keep it simple. So the first one is the proposed amendment around pay as you earn.
Yep.
And basically what the proposal is all about three things. One, the pay as you earn threshold is going to be increased from 235,000 a month to 335,000. So an addition 100,000 is being added. And I'll speak to each of the changes there just shortly. Then secondly, an introduction of a new rate, which is a 25% rate that is being introduced. So prior to this, or currently what we have is 10, 20, 30, and the supposed 40% rate. So there is a new introduction of a 25% rate. And lastly, there is a proposal to repeal the 10% rate. So that's from a pay-as-you-earn perspective. What that helps is that once this bill is passed into law, it means 335,000 of your income is not going to be subject to tax. Not a very significant amount, but depending on the different tax brackets, you'll find that there is a saving on a monthly basis, which ranges between about 10,000 to about 13,000, depending on the bracket within which you lie. So that's a very welcome amendment. Yes, there have been arguments to increase that, but at least it's better to start somewhere. So at least if this is passed into law, so we expect that 335,000 of your earnings, or of our earnings, will not be subjected to tax. Then the other one is from a commercial perspective, one around the interest. So currently, from a Ugandan perspective, if you incur interest and you're part of a group, all that interest is not allowed a deduction. So it's limited to 30% of your tax earnings before interest, tax, depreciation, and amortization. So the change is two-way. One is the amendment currently was only looking at, say, the commercial banks. Now you're including the microfinances and MDI. So it was just looking at like the first two tiers. So now you're including the MDIs as well as basically tier 2. So what that means is that if it's a microfinance and the microfinance has an interest expense, that interest expense will not be limited by the supposed 30% of your tax earnings before interest, depreciation, and amortization. Then lastly, from a wider perspective, which is then going to affect, someone who's dealing with the telecoms, is that the withholding tax on that within the telecom space has been widened. Before, it was a 10% withholding tax rate was applying on payments made to agents. And those agents were really around either it's airtime distribution or data around that. Now it's been widened to cover all telecom service providers. So if you're selling bundles, you're going to now be caught by this. So everyone who's within the telecom space and you're doing something that is linked to telecom and not just supplies, it means there's going to be a 10% rate going forward. So yeah, I would say that's what has caught my eye.
Thank you for that very insightful discussion, Trevor. Just to pick it up from where you stated payee. Very interesting. We last saw a revision of those thresholds in 2012. The feeling for the ordinary taxpayer out there is that this revision is coming in 2026. Does it account for the supposed inflation that has occurred within that time? What do you have to say about this?
Yeah, and there's always got to be that debate as to whether it takes consideration of the inflation. Certainly not. But I think when you look at the proposed change, I think you would rather start somewhere. And I mean, if you've been earning less than that, then at least you know you're not going to be subjected to tax. But 12 years, 13 years is quite a long time. So if you're looking at a change that comes in 14 years after, definitely the inflation rate has changed, but you can't also be that accurate to then say this is going to be commensurate with the inflationary rates, but it's better than nothing for now.
I like that. It's better to start from somewhere. Ian, I'll pick it up with you. What are some of those proposals in the income tax amendment bill that stand out to you?
Thank you, Noah. Maybe just add on to Trevor's submission. The amendment of the pay-as-you-earn rates kind of like increase someone's disposable income, so to speak, because now the exempt or the zero rated rates have been increased by another 100,000. So you have another 100,000 in your pocket, so to speak. But for me, what stands out majorly in these bills is the fact that Alfred talked about this, the interaction of the law with the ledger. I see many of the amendments have come out of court decisions. So anything that you point at in the amendments, I could easily point you to a case that has brought up that change or a case that's being brought in to revise a particular position. When we talk about EBITDA, again, I think Trevor has spoken about it, but there are different cases that keep coming in on the interest capping. For me, what has stood out mostly for me, one, the withholding tax on the gaming wins. Again, I'm a lawyer, so I'll refer to the cases and then I connect to how the two play together. So in 2021, I believe there was a case called Fortuna versus the URA that came in to say, look, you cannot tax someone by merely spinning or playing a slot machine. And at that point in time, we could not define what winnings in gaming would equate to. And consequently, 2023, the law was amended to remove that withholding tax because it didn't understand what a winning would be. Unfortunately, I think last year, or 2024, they're about 2024, 2025. Another case, Masalia SMC Limited versus URA, comes in and says, look, a winning in a gaming activity would be what you stake and what you actually win or the gain you actually get out of that. So the law comes in to say, look, the withholding tax that's going to be charged will be on that particular difference between what you've staked and what you get out of it. So for me, I think that's a welcome measure because here is the law now coming in to shape or the court coming to shape what the law should be. And most times that's what happens. Court decisions come in to bring into clarity on what the law should be. Dispose of a non-business asset. So withholding tax on a disposal of a non-business asset has been proposed at 6%. Now, this is also interesting because it presents three issues. One, no one ever disposes of a non-business asset with a view of making a profit. You're selling off your fridge, you're moving out of the country and you're selling off your chairs at home. It's a non-business asset. You've disposed of it. Should you then get a withholding tax on that? Then two, what's a non-business asset? Can we define it? What would be the exclusions to a disposal of a non-business asset? And these things have also been playing in case law. People have disposed of their properties, their land, and someone says it's not a business asset, so to speak, and therefore does not attract capital gain and withholding tax. I think a famous case of Amos Nzei on disposal of property comes into play. And the law is saying, can we expand the tax base by taxing this disposal of non-business assets. But also ask a different question of, if this is being amended to have non-business asset included in property income for tax purposes, do we also amend Section 21 on the exemption on that income that's not included in the business income? Do we also have to amend that particular section? So this particular amendment is problematic in my view, and needs to be taken with a pinch of salt as they're making these amendments, and have to reconcile that with the definitions and also other sections that provide exclusions. Otherwise, you're going to make more work for the lawyers to litigate in court. And the third one that stands out for me, Noah, is on the withholding tax proposed for interest paid to foreign lenders. This was also very interesting because we had a famous case, Kalangala Infrastructure Services versus a URA, which clearly stipulated what the law says at this point in time, that if you raise a debenture out of Uganda for purposes of raising money out of Uganda and interest is paid out of Uganda, that interest is exempt. What the law is coming to say after that case is now that interest should attract a 5% withholding tax as you're paying the foreign lender. As you know, Uganda imports a lot of foreign capital. We're a net import of debt. So that, in essence, most agreements that you do, debt agreements, usually push that liability on the borrower. So the cost of debt will increase by 5%. Now, in a country that needs FDI and a lot of foreign debt to come and mature, how does that play out in those circumstances? We need to make sure that the law does not now clog investment and stop foreign direct financing coming to Uganda, because the cost of borrowing then will be increased. So I'm happy with the way the law is playing with the ledger, but we should be careful on how we interpret and change these particular provisions to affect the economy as well.
Thank you, Ian, for those very important insights. Just like the judicial decisions have shaped some of these proposals, the tax shall inevitably shape how we conduct business in Uganda. At this point, I want to bring in Alfred. What stands out for you in this income tax amendment bill, and why?
Thank you, Noah. And I think I'll start with a positive, which Trevor and Ian have looked at, and that is the payee brackets being visited. And I did a quick calculation on someone who is earning 1 million before I came in, and as Ian has said, 100K in the pocket. But I also saw the when you look at the calculation using the rates as they are now and the rates as they are going to be, there is some good saving of around I think that it was around 150 something. That is if you look at someone earning 1 million. And it has always been at the back of my head that people who are in employment, there are some of the highly taxed people. So this is something which is so much welcome. Does it take into account all the inflation, or does it even give does it relieve so much weight? I don't know. But step by step, anything small, you welcome it. What stands out for me when you look at the amendments in the Income Tax Act, that is going to be, first of all, the hotel establishments getting an extension of the exemption, 10-year holiday exemption, which has been open to people in free zones and industrial parks. It has conditions, that is 70, where you have to have 70 of your raw materials, 70 of your employees being Ugandans, raw materials sourced in Uganda, and 70% of the wage bill being to Ugandans. It's a welcome amendment. I'm not a fan of exemptions, incentives. I'm so much vested in international tax.
You used to work in URS.
Yeah, but incentives are not. But this one is a substance-based incentive. It's really saying have substance on the ground. and you have your 10-year holiday. So it might be a good one. The problem within it is when you look at, for instance, guys who are having operations in industrial parks and free zones, the foreigners are at 10 million, then the 30 million or 10 million. But I'm more interested in the residents. The residents are at $300,000 within Kampala, then $150,000 in investment outside Kampala. This amendment needs to be looked into before, because it sort of says 10 million for foreigners, 5 million for residents. Now, there's some disparity because you had already taken into account that you want to appreciate an investor who takes an investment outside Kampala by reducing the threshold of investment. I think it is more necessary actually to replicate this in this amendment so that a person who takes a hotel outside Kampala gets, because $5 million for Ugandans, not many. So it means you're cutting out a lot of guys. $5 million investment, you're cutting out many guys. Then the second one would be a very interesting amendment coming from an accounting perspective. That is on the alternative minimum tax, where it is something that has kept on coming and coming, but it is now getting out of hand. That is on losses. Well, it is something that came, I think, a few years back, where we saw 50% of your losses after 7 years. You forego 50% of your losses. Well, that was okay. But now we see an amendment coming in, and it is saying we want to get firmer and tougher on guys who are making losses. And we are introducing either you have, it's the greater of 30% of your chargeable income. And if you're making losses, it means you don't have chargeable income anyway. So you're creating the greater of 30% of your chargeable income or 0.5% of your turnover. So it means 0.5% of your turnover will always be the higher. So you're taxing a guy who is making losses 0.5% on his turnover. That is absolutely inconsistent with income tax principles. And going back on ground, a business that is making losses, I was having a very interesting discussion with someone recently, and it bet his understanding that I'm making losses and you're asking me to pay tax. For him, the problem was a penalty because a return had generated penalties, yet he had filed in his return losses. So he's not a lawyer, he's not an accountant. He just couldn't understand why penalize me when I'm not even making a penny. I'm just putting in money. Well, it's understandable from a URA's perspective. It is an issue of we don't trust these losses. Where that is not a taxpayer's problem. Increase capacity to audit these losses. There is a provision in section 22 which requires people to put things when they are claiming expenses which are above 5 million. Emphasize such provisions such that you can at least trace an expense which is driving this loss to someone with a tin, and then you can say, okay, you're making losses, but I can follow up this expense to someone who has earned it as an income. So it is not something that should, I think, go beyond even the committee stage, because URA should simply increase its capacity to audit, not now going against the basic principles of income tax. Then lastly, I think it is there's an amendment coming in on residents who have income from foreign sources. And it's an amendment. I'm still wondering, what is it for? And when you look at I got a chance to look at some write-up, which says the intention is to tax residents who earn foreign income like any other persons in Uganda who pay tax. But the act is very clear. all residents under Section 17, gross income of a resident includes income from worldwide sources. So just gross up everything. You don't have to now say this has been earned from maybe foreign sources. Or it's the act is very clear. I don't see the reason or the intention or the purpose of that amendment. And I can go on and on. The income tax is wide, but I just think those are my key 3 amendments, which I feel I have a bit of concerns. They are good, especially the hotel bit, but these other 2, not at all.
Thank you, Alfred, for those insights. Your discussion points out to me something about the government policy. They seem to be trying to increase the tax revenue through all angles. However, some of these amendments have, as you've rightly stated, already contain provisions or supporting provisions within the Income Tax Act. Just a follow-up to that, the amendment of the foreign sourced income, what is driving it? What could be the reason behind it by government?
Well, the reasonings I've actually had a chance to look at, it is more of there has not been capacity to tax these incomes, much as we've been having provisions that these incomes to be taxed. And you can see that it's already clear there's an appreciation that there are provisions that these incomes can be taxed of residents from foreign sources. Yes, so that acknowledgement is there. Then an amendment is being introduced, apparently, to now sort of operationalize. And that is, I think, failing to appreciate that the mechanisms have always been there. Just welcome the international framework on automatic exchange of financial account information that is now availing the URA with all these sorts of information, especially with respect to residents who have foreign sources of income. Appreciate that framework, receive that income, fall back to the existing provisions in the same Income Tax Act. There is no need to introduce a new provision, because if it is interest or dividends, which is, I think I saw, is being targeted, it's already included in what is gross income. Gross income is business income, property income. Property income includes dividends and interest. So proceed to tax the person as any other resident. So there's no need to now split hairs. Oh, this is foreign, this is, and then we have to make an amendment. Not necessary at all.
Thank you, Alfred.
You're welcome.
Trevor, flowing from the discussion of an international perspective, you practice a lot of international tax. We are also seeing a provision that seeks to oblige a taxpayer to prove that the transactions are at arm's length. Is this a new thing? Does it need to be specifically provided for? What are your views on this?
Well, good. Well, the time I read it, I was also asking myself why. So, and simply because because of 2 reasons. One, the arm's length principle, because the provision it requires that where there is a controlled transaction, so then the taxpayer should provide information with respect to that transaction. Currently, we have about 3 or 4 either provisions or laws that provide for that. One, from the income tax perspective, so there is already a requirement for associated companies or entities. So once you're an associated person, you're then caught by the arm's length principle in terms of providing for your related party transactions. So that's a requirement, which is then embedded through the transfer pricing regulations that require documentation. So at that level, we are talking about the arm's length principle and making sure that the taxpayer should be able to provide necessary information in as far as the control transaction is concerned. So if that is provided for, so the question is, why then include this? So one of the write-ups that I was seeing was that taxpayers are not providing information, and therefore the URA or government thinks that provision should be included. However, the question on provision of information should not arise because, like I said, there are various either laws or provisions. So in as far as the Income Tax Act is concerned, so Part 11 would cater for that in as far as arm's length is concerned. Secondly, the transfer pricing regulations would cater for the documentation. Thirdly, if that taxpayer in question is operating within a treaty country, that information can be obtained in accordance with the tax treaty with that country. Then lastly, if the taxpayer is not in a treaty country, the URA can still obtain that information via exchange of information because Uganda is a signatory to the Convention on Mutual Assistance in Tax Administrative Matters. So in my view, it's not necessary, and you'd want to also understand where the taxman's coming from because that has been exhaustively provided for, either within the main tax legislation or via the treaties and agreements that Uganda is a signatory to.
Thank you for that clarification, Trevor. Ian, I want to also pick on your expertise. You are a celebrated entertainment lawyer.
Not an entertainer.
The entertainers are your clients. Maybe that will put it more rightly. There is a proposal that seems to touch on your clients. Can you break that down for us?
Thank you, Noah. The proposal is a withholding tax on payment to public entertainers. I think for a long while, the URA has wanted to get some bit of this money that entertainers make from public entertainment or any other revenues that they have. And I think in this particular round of amendments, they're looking out for how best then they can tax these entertainers. But most of them are not on the book. You book someone for a wedding and a person comes and goes, that money that you cannot really trace. So they're saying instead of letting them go scot-free, can we now have a little bit of withholding tax from the people who are paying them or from the promoters? They call them promoters. So if you have a promoter who's going to pay you, then they'll ask them to withhold. It doesn't encompass all the whole entertainment industry, and there are some nuances that keep coming in, but it tries to somehow level the ground to have the entertainers pay their fair share of tax, and if they can then file their tax returns after that, they can get that credit that has been withheld. So I think it's a good step to widen the tax base. But there's still some nuances that the law needs to take into consideration. For example, you have entertainers who have managers or record labels that manage them. When you withhold from that entertainer, like it's an individual, but it's actually a company that actually supports them. So we need to have those nuances recognized in the law, so that is not a blanket withholding tax. But it's a welcome amendment in my view.
Thank you. These are very important insights into some of the proposals included in this year's Income Tax Amendment Bill. I want to move it along to the VAT Amendment Bill. Trevor, you do a lot of compliance work, advise clients. What are some of those proposals that are contained in that bill that are pertinent for us to understand?
Okay, but before I go to the VAT, Ian mentioned the nuances, and being the entertainment person here, he will have to tell us what a public entertainer means, because, is it Nanduja? Is it some DJ who comes to perform? So
yes,
he's been in this market, so he needs to tell us, and he will have to clarify that in terms of the nuances. But back to VAT. So the VAT amendments are not as many.
Yeah.
So they're about 9. And the good thing about them is that there is really nothing that is increasing tax per se, because most of it is either just clarification. The one amendment that you would say is geared around increasing or mobilization of tax is the specific clarity around software, to then say software would not be allowed an input tax credit. Outside that, most of it is really relief, and the biggest one being the VAT threshold, which is being increased from 150 million to 250 million, similar to the discussion that we had around pay as you earn. So once you are above that threshold, so from a VAT perspective, then probably about 2 things there kick in. One, from the URA perspective, it means the level of compliance or cost of compliance is going to reduce, because then you're not following up on so many people. But then again, from a day-to-day perspective, if you've been making 200 million, it means you'll no longer be eligible to register for VAT unless you're going in for a voluntary registration. What that means is that once you're not registered for VAT, then the whole neutrality in terms of you claiming the VAT goes away. So now you have people who will be falling below a bracket of 250 million, all of a sudden becoming final consumers. So then they will have to pay VAT because they can no longer claim the credit. Then what that means is that government is trying to streamline the whole VAT neutrality and productivity of VAT, because the more people you have within the VAT bracket at a lower level, it means you're going to then increase your cost of compliance. So with that reduced, so we expect more VAT to be collected, because then the VAT neutrality goes away. But then secondly is that the cost of collection for the URA will reduce. Then the other good one is around the IFRS in terms of withholding VAT, because if you're receiving the amendment, one of the proposals is saying if you're receiving an IFRS invoice, then you shouldn't, withhold VAT of the invoice. What that helps is that in the past, everyone has been withholding from everyone. But then at the URA end, you have that information. So there is really no reason as to why you should be withholding the VAT, yet already that information is real time in terms of once a transaction is made. So that's a welcome move, especially for those that are registered and are using the IFRS platform. Others are to do with exemptions here and there that have been included, but to me, those would be the quick wins from a VAT perspective.
Definitely. Trevor, thank you for those insights. That increase seems to answer a cry of many of the traders that the threshold for registration of VAT has been cumbersome. Maybe it is an answer to their prayers. Do you have any views on the VAT amendment bill?
My issues on the software, the fact that they want to disallow input credit on software, it's problematic in many ways. First and foremost, there's some software that's off-shelf. So I'm buying software off-shelf. Can that be, you're in essence making it a service, so to speak. So that it codifies an import of a service. Therefore, you cannot claim that VAT, that input VAT. And I think that's problematic, because if it's an off-shelf software, then it cannot be a service. It's a commodity. It's a pass-through. So they need to clarify that. But then also, how does that impact on internet penetration or technological advancement? We don't have local software developers that are going to develop that sophisticated software that we need for our businesses, for banks, for law firms, audit firms. We don't have them here yet. So if you create, so to speak, a block on importing of software by disallowing that input VAT, then you're going to create issues around software development. So for me, I take issue with that particular amendment because it nullifies many aspects, including technological advancement in Uganda. And I think that should be rethought and not put in this particular amendment.
Thank you, Ian. Those are definitely views we need to keep in account while the bill is being considered by the Parliament. While we are considering these proposals, let's move to other tax amendment bills that also touch our everyday life. Alfred, I want to bring you in with the excise duty amendment bills. We are seeing proposals on everyday commodities. What are some of these proposals? How do they affect our everyday taxpayer?
Thank you. No, and excise duty is an area that I think it's like that soft spot for when we were preparing for this podcast, I overheard someone say excise duty is always, being squeezed and tightened, and excise duty is a tax, if I may say in quotes, which is meant to it's like a sin tax, as some people always call it. It is supposed to discourage maybe bad habits such as smoking or things which are environmentally degrading. From that perspective, we then have to view the act, or the Excise Duty Act, from an angle of one, is it being used to achieve that objective? Now, the other objective that has always come with excise duty, which we see across actually most nations, is it is also a protective, to protect the economy or to protect local domestic production. So those two are good objectives from when you look at that act. Then, from Uganda's perspective, I don't know if this pandemic is across Africa, but it has become a revenue generating, which should never be the case as far as excise duty is concerned. It is interesting that if you look at the amendments, you have, you could look at diesel, petrol, an increment of around 200 in excise duty. You look at unddenatured spirits, that's the whiskeys and gins and everything that are imported. You see they're also being touched, I think, from 1,700 to 3,500. There's an increase there being done. Then I think there's also a motorcycle, boda being, I'm just looking at them from an angle of, if we were to look at these amendments from a perspective of achieving the intention of an excise duty act, which is to discourage bad consumption, to discourage degrading, So spirits, I understand. Petrol, diesel, I understand. Yes, we move, but it's destructive to the environment, those fumes and everything. Boda, I think, boda, I understand. For boda, I think there's also an aspect of it is an informal sector where government has failed to tax these guys, even from an income tax perspective. So they are looking at increasing that excise duty to 500 so that it is an administrative approach to tax that sector, as far as you can't tax their income. They are off the radar. So let's get them, when they are buying that boda, pay 500,000, go and ride your boda. Then, so those are like 4 or 5. Those ones which you would say, but now there comes in, these are interesting amendments. Proposed excise duty on construction materials, paint. There is a proposed duty on ceramics, tires. Those two are proposed. Well, the argument is the construction sector is not paying their fair share of tax. So the same argument on the boda guy, these guys are off the radar. These guys, they have tippers. They have these things with Chinese trucks, Sino trucks, and everything. They are booming. They are all over the place. So how do we get into this construction sector? Because when those things are booming on the road, if there are too many on the road, it means that is a sector that is thriving as far as domestic production is concerned. But when you look at the figures from a tax perspective, zero. So you would understand the pain of the Revenue Authority or the Ministry of Finance to say, okay, let's now put some of these easy to collect taxes, ceramics. But what are the ripple effects? These are some of the baby industries we have in the country. Paint. These are some of the, and where for paint, for instance, I think there's 3% for locally and then 10% for imported. But still, then there is an increase on cement as well. So the construction sector, I don't know what is going to happen to the construction sector if this goes ahead. But that is a tiny problem, by the way. Then I think the last category, I saw an increase on sugar and cooking oil. Those are, but the way I've categorized them, the first class, the 5, diesel, petrol, motorcycles, those ones, it's okay. They are negative aspects. Spirits, in any case, people who consume spirits are people who have disposable income, so they can stomach the tax. So that first category, well and good, still within the objectives of an excise duty. But this other category, construction sector, financial sector, I think the appetite should go down in, mobilizing revenue from that approach. It's not good at all. Thank you.
Thanks, Alfred. Just a follow-up. I like how you've categorized, first of all stated what the purpose of excise duty is. And you've shown in some instances it can be necessary. However, there are items they are taxing which are not necessary. Now, some of the proposals, especially around the diesel and petrol, are coming on the backdrop of increasing oil pump prices, right? So the general question out there is, are these proposals in a vacuum of the economic reality on the ground? Yes, we need to discourage, but due to global outcomes, the price is already shooting up,
The Strait of Hormuz.
So what are your views on that? Would like to.
Well, I don't know if the person who submitted the proposals, by the time, I don't know if someone forgot to remove diesel and petrol, because the Strait of Hormuz problem started way back in March, and these things actually, if you look at how procedurally, 1st of April is when they come to us in the public. I expected someone, like you've rightly put it, to have said, diesel and petrol, let's remove it. Why? Because many other countries, the other day I was reading, I think, as recent as yesterday or the other day, is it Portugal, is it Spain or Italy? They have just scrapped, their legislative arm sat and scrapped any duty as far as gasoline, diesel, petrol, everything is concerned because of the problem that is ongoing in the Middle East. Here, okay, I don't know. You're spot on. I don't know why diesel and petrol is still there. Either someone forgot to, let's remove that thing.
Yeah.
But maybe if you're watching this podcast, I don't know how soon to go out there, but I hope maybe someone in the process, because this is not a finality, there are still bills, someone can crack it out and say, let's not appear as if we are in a vacuum. Yeah.
Definitely. These items touch our everyday life. So these are proposals we are going to keep a keen eye on. Ian.
Yes.
Let's talk stamp duty. You do a lot of registrations. You have a lot of transactions which involve stamp duty. What are some of the proposals in the Stamp Duty Act? And there are not so many, but they all seem to be eye-catching.
Well, I want to give a disclaimer. I don't do a lot of stamp duty acts. I may be seeing this and think I should account for stamp duty. Further return. But stamp duty is interesting. I think some of the things that have stood out for me, one, the increase in duty on transfers from 1.5% to 3%. 3% on any scale is high. I always argue that tax can go up to a certain level, but if it stops going up, it must go out. So you increase the tax base rather than increase in the tax rates. So what's happening in this particular situation is, yes, they've given us a leeway to pay as you earn, but they've come to punish us somewhere else. Many people do a lot of transactions. So look at yourself transferring shares, for example, transferring land, for example. You're looking at 1.5% before and 3% moving forward. If that proposal passes, it would create good revenue, but I think it would stop many people from transferring particular assets that they have. So I think that particular proposal should not see the light of day. I think it's almost twice the amount of stamp duty. I think it's a little bit high. The other issue I have is the retention period for documents. So the law is coming in to say something interesting. It says for at least 5 years. So what does at least 5 years mean? Is it 3.5? Will I be safe on 2.3 or at 4 maximum? It says at least 5 years. I think it should be definite. If you look at the TPCA, Tax Procedure Code Act, it talks about 5 year period of 5 years. So it gives a definite period. So I think the Stamp Duty Act, if it wants to have an alignment on retention of documents, it should remove the word at least and say a period of 5 years. I think there's an error there. Then there's an issue that also still disturbing my head. I need to wrap my mind around why that particular proposal was made. But I think Noah's case, EcoBank versus URA, has something to play on that. I want to tie it there because in that case, I think EcoBank was being tasked to withhold and pay stamp duty on particular instruments that they shouldn't have been withholding on and paying stamp duty on. So the law comes in to say that for financial institutions that receive money on behalf of the URA, when you go to pay stamp duty, you raise a PRN, you go to DTB or Stanbic or EcoBank or whichever bank you go to pay that stamp duty. They're saying once you make that payment, now the financial institution has the mandate to file a stamp duty return. So that URA reconciles on who has actually paid stamp duty and if they've paid the right duty. Now, it's interesting because that process involves you raising a PRN for a particular transaction. You take it to the bank and they pay against the PRN, which reflects it's something URA can use to track that payment. And they can do an audit to find out if you've paid the right duty or not. But they're telling the banks that it's now on the onus is on you to tell us who was supposed to be paying duty. If they paid duty, you received it. So I'm struggling to see the compliance aspect of it. In a way, URA is, or the revenue collector is trying to push their responsibility to a taxpayer at the burdening of financial institutions. But I think Noah's case, again, has something to do with that. But I'm not tying them together because it's a totally different facts. But I'm seeing the URA coming in to tie those particular two things together. So for the Stamp Duty Act, those are the different amendments that have been proposed. Maybe the other one is on transfer fees for motor vehicles and motorcycles. They have increased to 200,000. Those who are going to buy new cars or going to buy cars that are not very old, you have to pay 200,000 on the transfers as a duty. And then for the motorcycles, it's been raised to 50,000 or it's proposed to be raised to 50,000. Those are the changes in Stamp Duty Act that I think I take issue with, but also some of them probably should be a good revenue source for Uganda.
Thanks, Ian. You mentioned something interesting around the retention period under the stamp duty. For the longest time, there has been that discrepancy between the stamp duty and the TPCA. TPCA provides for periods of retaining documents and periods for issuance of assessments. Stamp duty is not regulated by that and is silent on it in its own act. Yeah. Could this be a measure to bridge that gap
yes, it is a measure to bridge the gap, but as I said, they shouldn't say at least 5 years. They should align and say a period of 5 years, period of 7 years. That's an alignment. But if you say at least 5 years, again, you're giving us tax litigators more money to litigate on what at least 5 years would mean. And it could mean anything between 1 to 5 years. Because if I keep a document for 12 months, so I kept it for at least a year. So we need to be clear on that period so that we don't have any interpretation issues.
And interestingly, we are seeing the motorcycles featuring in stamp duty again, just like they did in the excise duty. So they are really facing it rough. Trevor, let's talk trade. There are proposals which have been put up in the External Trade Amendment Bill. They are targeting certain areas. Can you break this down for the viewers?
Yeah, thanks, Noah. So yes, there are three proposals that are being suggested from an External Trade Act perspective. Two of those are, exemptions, and the other is the one that's revenue seeking. So the two that are exemptions, so we are looking at the importation of pesticides, rodenticides, herbicides, and all, to be exempted from the two levies or fees, one being the infrastructure levy and the other being the import declaration levy. The argument that is being fronted by the government is that those items are key items in terms of, healthcare, because if it's medicine, human medicine, if it's, herbicides for agriculture and all. So those are key inputs that should not be subjected to the import levy as well as the import declaration fee, which is a welcome move. The other is the controversial one on the increment that government is suggesting. They are suggesting an increase of 30%. I think it's from 15%. And that is on imported used clothing. Argument being that, one, it affects the environment because you're going to get clothing that was used in last winter, and government is saying by the time it's here, you've put it on for 6 months and all, you're going to dispose of it and it's going to affect the environment. However, the key challenge when you speak to the traders is that, well, that is well and good, but the biggest challenge is that when it comes to garments, the local production is not as sufficient. And one, it's not as sufficient. Two, that clothing is cheaper. So how many people can afford, they refer to it as, our local mivumba. So the question is, how many people can afford clothing that is not mivumba? Because the more you bring it in, there are so many people who can afford that. The price of new clothing, hardly, people in Moroto, Karamoja, whatever, and people in the villages may not really afford a shirt of 10,000 or 20,000, a new shirt. So the argument has been then, how do you balance that? Do you wait so that when the textile industry is really up and running, it's sufficient that you do that? Because right now, an environmental levy of 30% is very high for them. And it will most likely going to increase those prices. And at the end of the day, it all goes back to the final consumer who's going to buy that product, and they will have to pay that incremental levy.
Yes. Thank you, Trevor. We are seeing two proposals that are protective in nature, and one which is likely to be very controversial, especially to our traders, but also the consumers of those products.
Yeah.
Alfred, every year we are looking to see how the tax procedure is being amended. How is it being streamlined? What has appeared in the tax procedure amendment bill this time round?
Thank you, Noah. Before maybe I go to the Tax Procedures Code Act,
Yes.
talking protective, especially from what Trevor was discussing, I think I forgot the Cavera in the excise duty side.
Yes.
They are coming for the Cavera
Yeah.
because the excise duty being proposed on the Cavera, and not only the Cavera, all disposable forks, plastic cups, and everything. Those one-use plastics. My God, Cavera might go for this. If this goes through, because you're looking at 25% or USD 1,500 per ton, the moment the manufacturer passes that cost on the consumer, that guys in school will start saying, Cavera, oh, you've bought stuff for 1,000. Cavera is 500 shillings. And you just say, oh, let me just carry the thing. But yeah, talking tax procedure, interestingly, it is, it was introduced in 2014. That's around when I started my tax practice. But when it was introduced, it was, since then it is one of those acts that get a lot of amendments. This time it has only 3 amendments. Very commendable because, much as we are used in tax to say, we are used amendments every year, we want some stability as well, because it just disturbs the taxpayer when they can't. There are some taxpayers genuinely who try to catch up, but they realize things change. Let me just continue paying Ian because I can't keep up. So we have one amendment. I think that the most important amendment in there, which to me is a big welcome because it's been a pain for many, is the waiver, which has now been extended to principal tax. I don't know if people understand that, but it is something that is going to lift so much off people's backs. And I hope it goes through because you're looking at all principal tax behind 2016. And of course, the attendant penal tax and interest being waived. It's been penal tax and interest. But for all the reasons, I've seen the reasons. Well, if I don't want to know the reasons, the amendment is good. That is a very welcome tax procedure code amendment. The other 2 amendments are really housekeeping. One is on digital tax stamps. It's been interesting that if you're found with a bottle that does not have a stamp, you pay 50 million, just like a manufacturer who has also been found not affixing stamps on the bottle. So they're just amending to say, if you're found with a bottle, let's penalize you in a proportionate manner, 2 million. Let's maintain the 50 million for the real culprit. Then I think the other amendment is on IFRS. IFRS, the penalty has been in a manner that it is tagged to the tax, double the tax. You've maybe not used the IFRS platform, or you've done something to the machine or anything, or you've not used IFRS itself. So the penalty has been double the tax. But the amendment is coming in to appreciate, there is a notice that the Commissioner General put out some time back that expanded IFRS to other sectors. And most of those sectors, most of the guys are not even on IFRS, and they are not registered for VAT, and they were brought into the bracket of using IFRS, meaning they don't have that tax. Now, if you tag the penalty to the VAT, to the tax, it means that guy will never pay any penalty. So they are introducing a mechanism such that that guy who does not have a tax because he's not registered for VAT can also be penalized. So it is no longer penalties double the tax. But if I don't have the tax, what do you do then? Now let's introduce some, hard amount where we say if you have not used IFRS, it's okay. If you don't have any tax, you're going to pay, I think 10 currency points. Yeah. Yeah, I think not many amendments. You can say this time I've managed to squeeze them in 30 seconds.
But I can see you're happy with them. Yeah, do you have something?
Yeah, I'm curious. Again, the waiver for for tax principle 2016 moving backwards is a good amendment. And as I said, all these amendments, every time someone says something, I can tie to a case that really brought up those amendments. So if you remember a case of K-Files, I think it's the one that brought in most of these issues. But what's more concerning for me is a good amendment, but how does it interact? How does that law interact with the ledger? It would be interesting to see, because with all the waivers that have happened over periods of time, when you get to the URA and reconciling that ledger with those particular amendments, there's a lot of difficulty. So I hope this particular one is not going to be as hard to interpret as it should be. And we said, look, cut-off date is here, let's move forward. But most times when you go to the URA, when you get to the ground, it's something different. But I hope it can be resolved. But again, that amendment is very welcome. As Alfred said, it's a good amendment.
And I believe it's one that all taxpayers are keeping a keen eye on.
Even consultants, even advisors, even, I mean, we are all waiting to give that good news. You know what? Don't forget about that.
Yes.
Yeah, I think Ian raises a good, valid point, because, okay, for me, first, would want to understand what's the thinking around 30th June 2016, because that's 10 years ago. So there should be some thinking around that, and I believe government has some. But if you are to go back to, what Ian was mentioning around the stamp duty, the record keeping, if you want a clean ledger, why wouldn't you then limit it up until the document retention period? Because document retention is 5 years. So what would it hurt to bring it up until 2021? Because you want to clean it up. Yes, it could be a big ask, but if you really are interested in cleaning it up, if you really are interested to comply with K-Files and all, so there is good reason to then say, okay, let's start on a new slate going forward, and everyone is clear around that. But most importantly, what happens to the ongoing cases? Because some matters are under objection, some matters are under appeal, some of the tax is being audited. So what happens? So we need some clarity around that. And time and again, if you do not clarify that, that's when, like Ian saying, when you go on the ground, things are a bit different. So once you talk about an amendment that is waiving tax, it has got to be very clear in terms of how it's going to be implemented and who it's going to impact, which we are not seeing in this tax law. But yes, it's a welcome amendment.
You've all raised some very pertinent policy considerations that ought to be revised and taken into consideration. Ian, you gave us an understanding on the withholding tax on gaming wins. We have seen an amendment in the Lotteries and Gaming Act. Please highlight that for us, and then you can also conclude with the changes or the proposals in the Traffic, Road and Safety Act.
Thank you, Noah. The gaming is not a bigger, it's an alignment, so to speak, on a rate of tax between betting and gaming. We're arguing before here what's the difference between betting and gaming. I think it's all betting, because betting are games of chance. But in my understanding, gaming is when you go to a slot machine and play a game that's of chance. And betting is when those who do sports betting or other betting activities. So before that, the rate for betting was 20% and the rate for gaming was 30%. So the law is coming to a line to say, let's have a uniform rate of 30% tax for both gaming and betting without differentiating the two. It creates a good law because it creates an alignment. There's no difference between the two. So it creates an alignment and any confusion is averted. On the issue of traffic and road safety, I have very serious concerns here. It's a good law in as far as environment is concerned, and they're looking at environment management. But they are reducing, before the law, about the proposal, cars beyond 15 years could not be imported into Uganda, okay? The proposal now is coming to reduce that period to 13 years. And the penalties, it's between 0 and 50% environmental levy, depending on what yard you bring in. So between 0 to 8 years is 0%. After 8 years is 20%, 30%, 40% and 50%. If you 12 years plus, you're in 50%, I should add. But why I take issue is we are trying to encourage tourism, as Alfred said. And part of the tourism that I see happening in the rest of the world is what they call a vintage car tourism. So you've told someone you cannot import a car above 15 years. And that's a very recent car, by the way. If you look at Ugandan standards, 15 years is very recent. But if you find people who are vintage car enthusiasts like myself, there's a group I belong to called Classic Cars Uganda. So they do showcasing of classic cars. So you find someone has a 1952 Dodge or a 1903 Ford, and someone wants to import that car. It's a tourist attraction car. But because of the law, you're going to pay 50% environmental levy, or they'll say you cannot actually import that car into Uganda. And I've seen many people complain that I have a car that's a 1982 Mercedes-Benz that cannot be imported because anything above 15 years cannot be imported into Uganda. So we need to align the policies, the different laws, with what we want to have. So if a car is a vintage car and you've classified it as a vintage car, and we know what vintage is, it's not a Corolla of 2000. It is a Corolla of 1981. Right? And those are very rare machines. So if it's a rare machine and you're going to use it to attract tourists, there should be some sort of considerations to allow that importation. But on the law generally is welcome. Then if you look at issues of taxing or not allowing input credit for software, but then the cars that you want to import have a unique software that helps them charge. Again, there's no alignment there. We need to align these particular laws to say, as I'm punishing cars that are not environmentally friendly, I should also not punish software that's going to drive or create this particular movement of cars. So we need to align those two aspects so that the law is comprehensive. Otherwise, again, you're going to give me a lot of business, which I don't say no to, but we need to align so that we can be clear on those aspects.
Okay, so overall, it's a good law. However, it has to take into account certain nuances. Certain
aspects, yes, on technology advancements, but also the vintage car enthusiasts, so that they can also be able to bring. I can assure you, many people would like to go and see. There's a car, I think it's a Dodge, 1932 Dodge. It was owned by Ham Mukasa, 1932 or 1920 something. It's a green Dodge. And it's I think to the first one in Uganda. So you can imagine that car will want it to be, if you wanted to import that car back into Uganda and you can't, it becomes a problematic car. So a problematic issue. So we need to be able to balance those two things. But again, these are my passions, so I should not, my passion not drive the policy.
Valid concerns. So just the other day I was having a conversation with my border rider, and he was telling me, government is now taxing fuel, government is now taxing this. So Ian, just clarify for the taxpayers, at what stage are we in the tax amendment process? What comes next after this? Are these proposals final? Are they subject to change? What happens next after this?
I think, the process, tax process, is what they call a tax cycle.
Yeah.
So it starts with they'll do probably surveys. How do we increase the tax revenue? What will be the proposals? Different people have different ideas. They throw in Ministry of Finance, they compile these issues. Then they bring up what they call the tax bills. The tax bills arise from that whole process, the tax cycle. And once the bills come up, then they're presented to Parliament for first reading. That these are the bills we propose to have as law. Then Parliament then invites the public, and I think you've seen newspaper articles as well, or adverts calling for the general public to submit their thoughts on the bills. And I know the experts, Trevor, Noah, Alfred, have already given their views on these particular bills. So the general public needs to know that by the time it becomes law, you should have given your say. And this is a public gathering. So the finance committee invites the public, whether it's going to be a written or an oral submission. You go and then you present what your challenges are on those particular things. We have also presented our challenges to these particular bills and sent them to the clerk to parliament. After that is compiled and different views are put together, then they make the particular amendments on the bills or the proposals that have come in. They can drop some aspects, they can keep some aspects, or they can amend, refine some aspects. You could find, so for example, stamp duty instead of going to 1.5% goes to 1.8%, to 3% goes to 1.8%. There could be consideration that could happen. Then they'll take that bill back to Parliament for a second reading. Again, they'll be debating those particular aspects. And after that debate, they will have a third reading of the bills. And then they send them to the president for assent. Now, the president has 30 days to respond to Parliament. And if he doesn't, within those 30 days, then they become law, so to speak. But sometimes that process takes a while. The debates, the sending to the president, and then the financial year happens. Now, when the financial year starts 1st of July and the bills are not yet out or gazetted as law, because to be law, you have to have a gazetted act. There's what they call a provisional collection order, which allows the URA to collect tax in the interim before the law comes out. I think they're allowed 4 months, if I'm not mistaken, 4 months after the start of the financial year. And after that, they cannot collect that tax anymore. And we've had, I think, some cases challenging issues where the act is not yet out, they're still collecting money and all those things. So the cycle goes all year like that. But I must add that Uganda is one of those countries that has tax amendment laws annually. I think that's dangerous. That's why I think Alfred says you can't keep increasing the price of fuel every single year. It will reach a point where fuel is too expensive to have. And then what do you tax next? So we need to have what they call a tax breather, where we know that these proposals are going to last us another 3-4 years until the next tax cycle starts. But if you have it every year, it's good business for the consultants, but it's bad business for economy. We need to have some sort of assured tax system so that we not expect changes every year. Otherwise, investors, when they come into the country, the first question they ask is, how often do you change your tax laws? And you say every year. That alone spooks the investor. I cannot be in a country where I don't know what tomorrow is going to bring me. But if I know that the next 3 years is going to be this way, then it should be easy to do. But that's in a nutshell what the tax cycle is about.
Thank you, Ian. So taxpayers should have the confidence that the proposals are still being debated.
Yes.
They are still subject to change up until they are assented to by the president.
Yes.
But you mentioned something very interesting that I want to pose to the other panelists. Trevor, what are some of the proposals that we have discussed in here or that you have come across that you feel need some more refining, need some more amendment, or you feel they shouldn't even be in the tax amendment bills at all? What are some of those proposals that come to your mind?
Well, I'll start with, Alfred was mentioning around the proposal around the exemption on the hotel facilities and all, so that then you align it so that the investment capital threshold is reduced or aligned with what we are seeing currently in the Act. 5 million is a lot, so you'd want to reduce that to, let's say, $300,000 for investments around Kampala and 150 for upcountry, which speaks to what we are seeing for the other incentives. The clarifications that Ian was talking about in terms of the entertainment, very critical personal assets. What does a non-business asset mean? That has got to be clarified. So things to do, we were discussing the issue around from an income tax perspective. If you have not defined the losses, because Alfred was talking about the losses. But now the challenge, first of all, the challenge with that provision is that you're not clear in terms of the losses that are, because where we started in 2023 was that a taxpayer that has or makes losses for a period of 7 years will not be allowed to carry forward the losses, after a period of 7 years. Now the question is, if it's 7 years, it then goes into Ian's territory. Is it, and your territory, Noah, because for the lawyers, is it 7 consecutive years? Is it a year of making a loss within the 7 years? We have had 3 years and no one has answered that question. But before we even answer that question, we are now having an alternative minimum tax to then tax you more, even when we don't know when the 7 years kick in. So you'd want that to really be clarified. Then also for the provisions that if there are any provisions whereby government feels they shouldn't be effective 1st of July 2026, then that should also be very clear in the law. So there are a couple of things that need to be cleaned up so that we get certainty as well as stability in our tax regime.
And definitely we hope those are taken into consideration. Alfred, what are your views on this? Any proposals that need some more work or should be thrown out completely?
Thank you, Noah and Trevor and Ian. I will start with perhaps where Ian, especially on vintage cars.
Yeah.
I think we have to believe and accept that we are looking at tourism more inward than attracting people from out of the country. And Ian's point is critical to that. I hope the Uganda tourism team can perhaps watch this podcast, because these vintage cars, the guys who are going to actually perhaps pay a fee to come and see them, us, Ugandans. You see, that aligns so much with the government's move in that, or the strategic direction, or in that. Back to your question, I think the loss thing is something that has to be revisited. It is very disturbing, especially if you appreciate income tax principles. It's very disturbing. Can it maybe be looked into so that maybe you put thresholds? Can it be, because if I'm making losses and Trevor, my books are perhaps audited by PwC. It means there are enough controls internally. I've even gotten a very reputable external auditor. I give you my books, there is a loss, and then you again say, no, 0.5% of your turnover. We have to think about that. It's a very dangerous one, I think, if I may use the word dangerous. It has to be. Then the other bit, of course, is like I've already talked about, excise duty. The 0.2% on withdrawals. That one, I feel it has to be taken back. In fact, if we are so much, let's not look at revenue. Let's look at the impact, because we're already suffering with bank fees, charges. It is wrong. Let banks make money on interest, but on these fees, it's already too. Then you add excise duty. So if you add excise duty, you're just making something people are already burdened with. And there are very few people who use these financial platforms, and the objective, especially with the financial sector deepening, is to get more people in, not to squeeze the people already using them. Then lastly, I think it's going to be on. There's something that I have a background in the extractives.
Yeah.
There's something that I saw, but in the bill it is not there.
Yeah.
Deeming VAT in mining and petroleum. I saw a very good amendment where they were proposing to restrict it to exploration and development, which was very good because dimming is government, losing. As far as VAT is concerned, it's a serious leakage. So if we are looking at plugging, let's not touch these things like losses, and let's now focus on where we are already deliberately losing. Because if you look at a mining person and then you put a dimming provision and he's in production, I mean, that person should pay tax, correct the output. If you have input, well and good. If there's a balance, pay the output to URA. The licensees in oil and gas shouldn't worry because in any case, most of their produce will be exported. They will be zero rating. So, but mining, if they are selling, we have a lot of refineries here. That sector of the economy should really not enjoy dimming VAT when they're in production. It's an incentive in exploration and development, but at production, let the games, let it be fair. Let us all pay taxes as we are engaged in now productive activity. I think those are some of the bits I can say on the bills.
Thank you very much, Alfred, for those insightful discussions. Ian, do you have those proposals which you wish were refined?
I have one, and I think that's on EBITDA, the interest limitation. I think, again, case law comes into play here. I think SAI office comes in and says that while computing EBITDA, the losses carried forward are allowable deductions while computing EBITDA. The law now comes in to say they are not allowable deductions while computing EBITDA. Now that's an interpretation issue that can come into. So then they need to be clear on that particular front, but also on the aspect of what a group is. So the rationale of having this particular amendment, I think there was thin cap rules, then they bring in the interest capping rules. In my opinion, I think they are more on eroding bases and shifting profits. So if you have a group that's within Uganda, why should we have these interest deductions proposed? And I think it happened in the case of Aponye, and now Techno 3 comes in to say, no, if it's a dormant, so the only exclusion is a dormant entity in the group. But would it then apply if it's the group is local, is a local group? In my view, again, it's a personal view, I don't think it should, because you're shifting bases in one company, but you're putting it in another company that should still be liable to tax within the jurisdiction of Uganda. So I think we need to revisit that on a broader scale to one, align it with the international principles, but also to help companies within Uganda, group companies within Uganda, enjoy the privilege of intercompany lending, and also having one of the group entities dominant in that particular aspect. So I think the group dormant company is welcome because it follows Techno 3, but we also need to refine the entire arrangement around the interest limitation on that particular front.
Thank you, Ian. Trevor, I am certain you've been involved in the tax amendment cycle. You made proposals to the Ministry of Finance. You've appeared before the Parliament to debate the current proposals. Are there any of those proposals that come to your mind that you submitted but have not made it to the amendment, the bill stage, and you feel they should definitely be included or considered?
Yes, very much so. The first one is really the rental tax.
Yeah.
So our taxation of rental tax is really not good for businesses. So there is need to revisit that and clean up the whole taxation regime of rental, because especially for the corporates, I mean, for the individuals, arguments have been made, but for the corporates to not allow a deduction of interest where I went to a bank and a deduction of interest is limited. Expenses are limited, which are genuine business expenses. So I guess there should be a revisit, and government should really consider taxation of the rental business. Then secondly, one of the other things that we've consistently seen and should be looked into is the 30% deposit tax that is paid while going to the tax appeals tribunal. Government should really revisit that because we're continuously seeing a need to pay the 30%, but now there's a question of affordability, then a question of, in other circles, it's been challenged in terms of its constitutionality, especially if you're looking at, is it a procedural matter? Is it a legal interpretation? So, and given the amounts of assessments that we are seeing lately, the 30% tax deposit should be revisited in as far as either giving some discretion to the tax appeals tribunal to then say, for this matter, would then, either waive the 30%, or there should be a way of accepting the bank guarantees, and so many cases have been decided on that. But the whole issue is really to make sure administration of justice is fair, especially to the taxpayer down there who has got an assessment of 10 million. They've even never made 10 million, but they've got to go and defend their 10 million. So I feel that needs to be revisited, and the lawyers can advise on how that can be structured better, but there is need to revisit the 30% deposit.
Wow, that is a very pertinent discussion, one that has featured in many forums. The increasing number of assessments, the increasing quantum of value of the assessments, and in some instances, the quality of the assessments issued has brought into sharpened focus the 30% requirement.
Yeah.
Definitely something that has to be considered. Alfred, I'll pass it over to you. What are some of those proposals that have not been included in this tax amendment cycle that you believe ought to have featured or should be considered for future tax amendment cycles?
Well, perhaps I will look at it from my background in the extractives. I feel the extractives part, I think it's now part 10, is quite messy. I don't know why someone hasn't looked into it to say, okay, we are serious on the extractive sector, but the taxation is, if you look at how many practitioners perhaps are implementing that part, it will tell you what I'm saying. Or how many taxpayers will tell you, oh, we are actually implementing that provision under Part 10. And maybe, so there is that one. And but on the other hand, I think the major aspect is if we are looking at tax amendments, we should go back to the principles of laws, and we should understand that things like tax laws, and I'm trying to use layman's language. Things like tax laws are these are penal laws, or these are legislations which, if I could put tax in a better way, which takes money out of people's pockets. So to me, I feel we are dealing with policy issues that impact. It's not a law that maybe improves the welfare of people per se. It is a law that we deal with taxpayers, and just look at it at an individual level when you're paying tax. And now the message I'm just trying to say is when we're looking at these amendments which take money out of people, I think the policy direction should be how can we achieve fairness in taxation? And if we continue missing that, then we continue having amendments as we are seeing them, because you can see the whole panel seems to say if you on average 70% disapproving, this that shouldn't be happening. We should be, becoming happy. Apart from pay as you earn, the rest are just giving us those looks of, yes.
Thank you, Alfred. I couldn't agree more. We should strive for a more fair taxation system. Ian, I'll bring it to you also. What are some of those proposals that you wanted to see but have not seen, and you would love to see in subsequent taxation cycles?
I want to give a very academic answer, maybe more theoretical than practical. But I think it's important. I'll start with the first principles. Tax is with us. We all know it's going to be there for forever. But two, the law always follows commerce. So as commerce changes, so will the law. The tax law always follow that particular change in commerce. However, tax morality has to be put into consideration. What do I mean? Everyone knows tax is you cannot ask government what they're doing with your taxes. It's what they call a non-quid pro quo, right? It's not give me, I give you. But the tax morality comes in such a way that the social contract that's bound with that consideration of tax then will ask a particular sort of questions that we need to see the tax revenues being utilized in a right way. So for me, it's more broader than the narrow this amendment that have been made. It is more of, can we see the tax law aligning with our policy consideration, with our drive to middle income status, with our, the different things that government has put in place to make sure that people's lives are better. What we're seeing, the tax system is squeezing as much money as they can from a little taxpayers that they can have. If you put your head up and you say, I'm paying tax, I can guarantee you PwC is going to have a lot of work from you, because they will always be auditing you because you look like the person who should be paying the tax. But far from that, can we have a system that aligns with the policies consideration that we have? With that, you will find that issues of changing tax every year stop, because then you have a system that says we have enough pay as you earn, 40%, it goes up to 40%. We have enough corporation income tax, goes up to 30%. We have enough of this. Can we now utilize on expanding these taxes to cover a wider base? And you find that then makes someone who pays tax on a regular more comfortable to pay tax. You may not ask what it's done, what the tax is being used for, but the social contract is cemented by the fact that we are more people in the bracket, there's more money coming in, I don't expect this to go up tomorrow. So for me, I think in any tax cycle, if you have those covered, one, you understand it's a social contract, tax morality comes in, but also the aspects that the people who pay tax, if they're limited, they'll get tired of paying. And when someone gets tired, one of my teachers used to say that if you push someone so close to the wall, you should be careful, because they may get behind the wall and you start pushing the wall. So that's what usually happens. They get tired of this, and then they go behind the wall, and you push the wall. It won't move, So we need to have those considerations so that we can have a good tax system. Thank you.
So from all your three submissions, I notice a cross-cutting theme. We should strive for, first of all, a fairer tax system that caters for everyone. If the people are pleased with the taxation system, or it's not so cumbersome, inevitably in the long run, the government gets more. Thank you, gentlemen, for participating in this very important discussion. I think we have looked at the 8 tax amendment bills that have been presented to the Parliament, and these gentlemen have provided very insightful and in-depth analysis into the proposals therein. We have now a greater understanding of what the law is, what it is now striving to be, and what the effect shall be on you, the taxpayer, but on the broader economy of Uganda. Thank you, Trevor. All the way from PwC. We thank you and your broader team at PwC for your generous time and your expertise that you have given to the Tax Hub podcast. Thank you very much.
Welcome. Always a pleasure. My first time on the podcast, but yes, and thanks to the panel as well.
We definitely hope to have you back.
Sure.
Alfred, thank you very much. Alfred is a tax partner at Redmond Tax. We appreciate your time, the expertise you have demonstrated, and the care with which you have taken to answer or analyze the tax proposals that are before us or before the Parliament today. Thank you very much, Alfred.
Thank you so much, Noah. And thank you for the invitation, the Tax Hub. This is also my first time on this podcast. And I can only maybe look into the camera and say, if you're watching, of course, you're already watching, but tell a friend to, yeah, there is so much. You don't meet Ian every day, Alfred and Trevor giving out this free knowledge. So just tell a friend to watch, to look out for. Noah has told me there are over 14 podcasts now. So thank you for the invitation and keep it up.
Thank you. We are happy to have you here and hope to have you back. Ian is a tax partner at SM & Co Advocates. We are very grateful for the time you have accorded us today, for demonstrating your legal knowledge in relation to tax law and for presenting that knowledge to our viewers today. We are very grateful.
Thank you, Noah, and thank you to my very capable panel of discussants. I'm also happy to be here. It's the first time. I think I kept telling Edwin that, sir, you've forgotten me. And Edwin says, don't worry, your time will come. And I think he has the perfect timing. And I'm grateful that I've been here, the Tax Hub. But also for the general public, it's not on the consultants alone to be able to discuss these things. You can get involved. You can talk to someone who knows someone who can push for these particular amendments. And these cycles happen every year. So don't miss out. I think the Tax Hub is doing a good job to disseminate this information. So please like, share, subscribe if there's such a thing, so that this can go as far, as wide as possible. Thank you very much.
Thank you. And the Tax Hub shall always strive to have these very important discussions on emerging and topical taxation issues in Uganda. And we shall also always assemble a team of formidable tax practitioners to bring it to you practically and also in a way that will help you. This brings this edition of the Tax Hub to an end. We are still coming to you live from the Fontis Residence Hotel in Nakasero. Thank you for providing us with the ambient atmosphere to have this very insightful discussion. We also want to thank Dansoft Productions for ensuring that the production of this podcast has come out with a lot of quality and is able to reach our viewers. Thank you very much and have a good evening.